So recently, on the 5th of July, the last ditch effort, the last gamble to restructure the bank and have it viable. Frankly, it's a joke. You could just look at what's happened. Now, going to that viewer question on how an insolvent bank can survive, one way are funding rounds that are funded by, it might look like individuals or other corporations or governments, etc. But this cash was made very available by the global central bank's quantitative easing program. So this is one way that you keep a stock kind of looking viable, but it's declined 90%. You could say that that's a collapse. And truthfully, it wasn't really all that long a period of time. But now a run has begun because some of their key large hedge funds have begun to move their funds out of Deutschebank into other facilities to the tune of roughly $1 billion per day. So the run on Deutschebank has begun. One of the things that I really want you to think about in here, though, because we've seen it over and over and over again, is that the big kahunas that understand what's happening, they get out. What about the depositors to Deutsche Bank? You think they have much of a clue that their wealth that's held there is about to be bailed in? Just saying. Because really what we're seeing, and what I'm going to show you in a few slides, is that the central banks are already prepping for that dollar to gold reset that I talk about. And they're already prepping to allow gold to go to its true fundamental value. Not yet, not till they do the reset, but they've already begun to let it go. And we'll be talking more about that in near future videos. Because how do collapses happen? Slow and then fast. So this is the financial summary for Deutsche Bank out of its Q2 financial report that just came out. And one of the things that I want you to notice, and I've talked about this quite a bit, is the leverage ratio. And what that actually means is that is the amount of room that Deutsche Banks or any bank's leverage ratio, any bank's assets can decline before they are insolvent. So what that basically means is that they went out and they borrowed 97 cents to create $1 worth of equity, or $97 to create $1 worth of equity. So if that value of that equity declines by that in this case 3.9%, there's no equity there. So when there's a run, which has begun with Deutsche, even though they've been insolvent for a while and they've certainly had really crappy leverage levels, you know, the run is what's going to perpetuate their demise that they can't get out of. And it's already begun. That's why it doesn't matter what they did. July 5th, too little, too late, it's done. So that the lower that leverage ratio is, the higher the risk level is. They managed to get it up for a minute or two, but it's declined now from 4.1% down to 3.9%. That's really, really dangerous. Now, in addition to that, on their cost to income ratio was 112.6%. That means that they spent 12.6% more than they had coming in. And what does that equal? Well, that's simple. That equals losses. But you know, in 2008 was the first time in 50 years that Deutsche Bank actually showed a loss. I didn't really have time to dig this up. I'll probably do it for the next video I do on it. But every time I would go back to see how far back these losses went, it kept saying, well, 4 years, 4 years, 4 years. So you can't hold me to this till I actually pull up the data. But I know over the last 8 years, Deutsche Bank has not made a profit. How long can you go without making a profit? And this quarter's, the second quarter loss here, is the largest one going back to the first quarter of 2017. And they had losses in 17, 18, and for sure, looks like 19 as well. So I have to tell you, without any doubt in my mind, Deutsche Bank is a zombie company that has managed to stay afloat thanks to the good graces and all of the manipulations of the central bank easy money policy. And this, my friends, is why they can't change course. This is why they cannot raise interest rates, nor can they stop buying bonds, mortgage-backed securities, stocks, for God's sakes. Why the central banks, the sovereign wealth funds, the governments have to support the markets, and why it will drive us into first modern money theory, which is pure printing, which will bring on the hyperinflation. But we are super close, because without one doubt in my mind, Deutsche Bank is holding on by a thread. And I'm not sure that they have the ability, or the central banks even have the ability to hold that thread together. Because the problem really goes back to those derivatives, which are just leverage bets. They're a cheaper way to play, but that's the way all of the banks have been making their money. And that really started once they shifted in 95, they allowed the sweep accounts so that they could sweep whatever deposits you make into your savings account, into your checking account, into sub accounts, and then they could use that. Shortly after they did that, that was 95. But then, of course, we had the test of the speculative derivative market, and we're off to the races. It's much cheaper to buy a derivative, to buy an option, to buy a contract, than it is to buy the underlying physical. And so that's the way the banks have made a lot of trading revenues, and we know that hasn't really worked real well for Deutsche Bank over this last year, especially considering those losses. But let me show you what their derivative book kind of looks like. And I say kind of looks like for a couple of reasons. Number one, in 2013, they changed the formulas of how to account for these derivative contracts, and it's called compression and netting. So they can take, in the example, which I don't have here, but you'll see it in other videos on derivatives, where they can take something like a $452 billion worth of derivatives, and by the time they wash it through all their accounting procedures, it comes out that it only has a risk value of 9. Okay, so nobody really knows the true value that is at risk. So that's one reason why I say that. The other reason why I say that is I love their financial statement, where they are carrying the value on their derivatives at what is determined, frankly, what they determine is fair value. And there are 3 different levels. The first level, level 1, is market driven. So those would be exchange traded derivatives, things like that, where, at least at the moment, there is a reasonably liquid market with people buying and selling. They're more standardized. They're the kinds of things that came out after the 2008 crisis. Though all those derivatives created prior to that, guess what? You'll see in a minute. They're still holding on to them. So that's level 1. And that is actually higher than their level 3, but definitely not as high as level 2. And level 2 is where you get to be a little creative, because there's not like a real active market on it. So you can use a formula to kind of value what they might be. Okay. But then level 3, and that's where most of their derivative contracts are. But then level 3 are opaque. There is no market value on there at all. So frankly, it's anybody's guess as to how much that they are actually worth. Now, in their restructuring plan, initially they tried to find buyers for their derivatives, or at least some of their derivatives, and they didn't have a whole lot of luck doing that. because they would have had to have marked down, in other words, where they say 133 billion, they would have had to have marked that down substantially, because when they went out to shop selling them, the market just wasn't there. So what they decided to do instead was to maintain their derivatives. Okay, we're not going to sell them. Rather than sell them at current market values, yeah, because then it would have been impossible to hide in how bad a shape to the normal person. The guys that are in the background, the guys at the top and the central banks, they already know how bad a shape Deutsche Bank is in. But that would have made it a whole lot more public. So we do not want to write those down. We do not want anybody to know the true value or lack thereof of the derivatives that right now, hey, we get to say this is what it's worth. Now I'm going to start reading, and then I'm going to pull up this other part because the speak is ridiculous. Okay, so Deutsche Bank says, the metric we look at is how much capital we are freeing up from the capital release unit. So this is a new bad bank unit that they're setting up. Okay, at the end of this process, and who knows how long that will take, I don't think we're going to see the end of this process. Going to be done way before then, and I'll show you why I say that in a minute. Let's see, at the end of this process, the CRU, capital release unit, will release substantial capital that allows us to undertake this restructuring. That is just garbage. But they're setting up this bad bank unit so they can move this illiquid garbage over there and make their books look cleaner. The problem is that they did that when the crisis was unfolding in 2008, 2009, and they're still sitting with them because there's no market. But hey, most of the valuations come from either Deutsche Bank's formulas or Deutsche Bank's guesses. Oh, okay, I trust that. How about you? How much litigation do they have? Tons and tons and tons. They have made so many mistakes. But that's what I say. It's dead in the water. It is an absolute joke. The likelihood of them being able to go out and issue stocks and generate another funding round to keep them going, I think investors, and that could even be the central bankers, are getting really tired of it because they know that at best, it is a short-term stopgap measure. And the question is, what are they going to do? Going back to that viewer question, thank you, IMF. I love the IMF in so many ways. Some ways I really can't stand them. But I love their working papers. They just came out with this yesterday. How perfect was that last night? Public interventions in the financial sector. That is banks being bailed out. And that would certainly include Deutsche Bank, but frankly, it includes all of them. And you can see this starts in 2007, and the most current data, even though they just pulled this up, was 2017. And frankly, there was a pretty big difference between 2016 and 2017. 2017, they bailed out 16 banks. Well, what does that look like? Because, hey, who cares about the bailing out? Well, first of all, you and me, taxpayers, we're responsible for that. But, you know, you've seen and been watching the key central bank balance sheet. This one is what? The Fed, the ECB, and the Bank of Japan. So, you know, will they do more QE? Of course they will. They don't have any other tools. Will they do negative rates? Of course they will. They're setting up for it. We've been watching all of these pieces go click, 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 click. Used to happen more slowly. It's not happening so slowly anymore. And that is a big, huge trigger that should tell you that this crisis is very, 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 very near. because boy, I can't even do anything light these days. So will they print more? Absolutely. Will it save us? No, it will not. It won't save the system, and therefore, particularly if you're in that system, it will not save you. It will not. Because Deutschebank is connected to every single financial institution on the planet and has their finger in every single financial product that exists. You see how it's connected, whether it's the US, Europe, or Asia, and then all those little gray lines. We've looked at this before. Thank you, IMF, for that fabulous chart to show how everybody is incestuously intertwined and not in a good way. And this is why they've had to prop it up. But you get to a point where you just can't do it anymore. And it really does look like we're very, very close to that.